Everyone, and thank you all for joining in for this session on futures and options. Firstly, let me introduce myself. My name is Tarang Solani, and I am the product manager for derivatives, and I will be the host for this session on futures and options. It's a brief session on understanding of how you can trade futures and options and how you can trade it with HDFC securities. So it's a brief and very interesting session. So post this if anyone who is finding difficult to trade in futures and options and understanding the concepts of futures and options, they will have a lot of clarity about how to trade into this instruments, and also how you can trade in HDFC securities and what are the various offerings from HDFC securities where you can take benefit of it. So without wasting any time, I'll just start with this session. So equity derivatives, which is also called as futures and options, we have a lot of skepticism among the market participants that trading in futures and options is quite risky. You should avoid. But if you see majority of the volume which is happening in the market, especially in the NSE segment, if you see 90 to 95% of the volume has been contributed by the derivatives market. Why? Because more and more people are finding it interesting, and there is returns has been made in this segment. Hence, it is very you can say there is a lot of opportunity, and hence start thinking differently and prepare for the opportunity at hand which we have in futures and options. So I'm just getting queries. I'm not audible properly, and my screen is not visible. So can anyone write it on the chat box? Is my screen visible, and is my voice audible to you all? We request to please write it on the question answer section, which is there on the right hand side of the screen. Is my screen visible, and is my voice audible? Okay. Can I get more reply? Yeah. Thank you. Thank you very much. So basically, futures and options has a lot of opportunity. Yeah. So video is not there because of bandwidth issue. Hence, I have not switched on my video. You will be able to see my presentation and and you can hear my voice. Okay. So futures and options has a lot of opportunity. Basically, you can trade in different market scenarios, being it bullish, bearish. Also, there are a lot many strategies. If you have a view that market would be in a range bound direction, you can trade in that view also. And also, if you have a view that a market would show big movement in either direction, so you can trade in that direction also. So apart from bullish and bearish view, that is, you can take a long position and also you can take a short position. You can trade in all the market direction, and that is the beauty of this instrument. So now let us understand what is derivative. So derivatives could be of anything, being it commodities, currencies, interest rates, stocks, or index. So derivatives could be of anything. Our main focus would be on stock on index derivatives, which is listed in the NSE segment, that is equity derivatives. And just wanted to give you a brief that any instrument which has an underlying asset can have a derivative instrument, can have a derivative commodity or derivative trading possible into it. So being it commodities or currencies or interest rate, they all have an underlying asset which is traded in the spot market, that is in the cash market segment. And from there, they take a price reference and they can trade in futures and options market, taking a price reference of the cash market segment. So any instrument which is listed in the which has the underlying asset, they can have a derivative trading for that. So our main focus for this session will be stock derivatives and index derivatives. So what are the most popular derivative instruments? So there are 5 types of derivative instruments. First are the forwards, second futures, then options, then warrants and swaps. So these are the 5 derivative instruments, and out of which what is listed on the exchanges are futures and options. Rest all instrument are the over the counter instrument which has been traded by the between financial institutions like banks, AMC companies, etc. So forwards, warrants, and swaps are the over-the-counter instrument which has been traded between the financial institutions. But what a retail segment can trade is only futures and options, and these both instruments are only exchange exchange regulated instruments. Rest all are not exchange regulated instruments. They are also known as tailor-made instruments, but futures and options are basically exchange traded instrument, and they are standardized in nature. Now, what are the participants? So there are three types of participants. First is the hedgers. So hedgers are the one who basically enter into derivatives market along with its protection leg. So they don't go naked in any kind of an futures or options market. They simultaneously come with some kind of an hedging leg involved in it, so that their loss is minimized in case their view goes wrong. The second participants are the arbitrators, who constantly looks for the mispricing between futures options or between cash and future, and they take in benefit of the mispricing. If you see, the mispricing in rupees terms is very low, but the accuracy level is high, and hence they take a big quantity or big volume. They trade in big volume whenever they find any kind of a mispricing between any of the different segment. And last and one are the traders. These are the one who basically, based upon the market view on technical and fundamentals, they take a positions into the market. They are known as the traders. Now let us understand about future, what exactly the future is. So future has an underlying asset. As I told, every derivative instrument should have an underlying asset. Underlying asset is the one which is traded in the cash market segment. So if you take the example of Reliance, which is there in the derivative side, that is in futures and options, they take a price reference from what it is in the cash market segment. Hence, every instrument which is listed in the derivatives market, they should have an underlying asset for it, and that underlying asset is the one which is traded in the cash market segment. Second features are they are standardized in nature. Now, what do you mean by standardized? They come with a specific lot size. So if you want to trade one share of Nifty or one shares of Reliance in derivatives, you cannot trade. You have to compulsorily buy in a multiple of lot size. For lot size for Nifty is 50 shares. So if you want to trade in Nifty, you need to compulsorily buy in a lot of 50 shares, consist of one lot and a multiple of that. It also comes with an expiry date. So what is expiry date? Is basically the last day till that particular option contract which can be traded. So for stock options, stock futures, and index futures, we have an expiry date which is there on the last Thursday of every month. But for index options like Nifty, Bank Nifty, and now Fin Nifty also, they have a weekly expiry options. For Nifty and Bank Nifty, we have an expiry which is last Thursday of every week, and for Fin Nifty we have expiry on every Tuesday for a weekly instrument. So for a monthly contract, we have an expiry of last Thursday of every month, but for a weekly contract, which we have for only for three index, that is Nifty, Bank Nifty, and Fin Nifty, we have an expiry for Nifty and Bank Nifty is last Thursday of every week, and for Fin Nifty we have expiry on every Tuesday. Contract cycle: for a futures contract at a given point of time, there are three contracts which are available into the market, that is near month, next month, and far month. So based upon the view of the you can initiate a position. So right now at current month for the February, you will see for any future contract, you will see February month contract, March month contract, and April month contract. So you can take positions based upon your view on the market, how long term view you have, or short term view. If you have a view for a short term, you can initiate a position for the current series. But if you have a view for the longer term horizon for 2 to 3 months, then you can take a position in next month or far month contract. However, the liquidity would not be that much in next month and far month contract, but you can check if you are available, if you can make a trade into that. And one more feature is an important feature is physical settlement, which happens. Now, what is physical settlement? Now, firstly, this physical settlement only happens for stock futures and stock in the money options. Now, physical settlement is nothing but every stock futures and stock in the money options, if you let it expire on the expiry day, you don't square off your positions, then compulsorily either you need to take delivery of how much of the shares you are holding, or you need to take delivery, or you need to give delivery of the shares. So here initially what used to happen, because this concept have introduced since last 2 to 3 years, but initially what used to happen, every derivative contract, being it index, stock options, index options or index future or stock futures or stock options, all was been settled on cash basis if you don't square off your position till expiry. But here in this case, if you square off your position, if you don't square off your position before the expiry, you tend to basically settle this contract on a physical basis. So either you need to take delivery or you need to give delivery of the shares. So it's a very important criteria where you need to understand about this physical settlement whenever you are trading in derivatives market, because this type of settlement you need to understand, and if you don't want to basically settle your contracts on a physical form, you need to square off your positions before the expiry. So that is quite necessary, and you need to be careful. Square off your positions before the expiry, and if you want to, in futures, if you want to initiate the same position, you can roll over your positions. So yes, so if you want to roll over from February month, now suppose tomorrow is the expiry and you want to square off your position, since you don't want to go for a physical settlement, then what you can do, you can square off your February month contract and you can take same positions in March month contract, that is called as the rollover. So you can also roll over your positions based upon if you don't want to go for a physical settlement, or if you want to hold on for a longer period of time, then you can roll over this futures contract. Now, what are the advantages of trading in futures is basically first and foremost advantage is margin payment. So here trading in derivatives market required less amount of investment compared to what it is in the cash market segment. I will see this with an example. Now, suppose you are bullish on Infosys and you feel that Infosys price will go up from current level. So there are two things where you can take positions in Infosys. First, either you buy in cash market segment or you can buy in derivatives market. That is in futures market, suppose. So suppose if you buy in cash market segment, you buy 300 shares of Infosys, suppose it at 1500 rupees. Your total value of the position is 4,50,000 and you need to pay full 4,50,000 to enter into this contract. But the same quantity, if you buy it in futures, you don't have to pay full. You just have to pay an initial margin, which is for Infosys, it is around 20%. So 20% of the total value of your position, which is 4,50,000, that is 90,000. By just paying 90,000, you can take exposure of 4,50,000. That is around 5 times exposure you can take, and that is the beauty of trading in derivatives, that gives you the leverage and also basically gives an exposure to trade, and a small investment you can trade in big quantity. Second is mark to market margin. So here once you pay initial margin to enter into the position, your work is not stopped there. On a day-to-day basis, there is a mark to market obligation which will be received based upon the price movement. Now suppose you have bought Infosys at 1500 rupees and tomorrow it rises to 1600, which went into your favor by 100 rupees. So 100 rupees into 300 shares, that is 30,000 will get credited into your account. But however, you cannot withdraw because your position is still open, but it will show as a credit entry into your ledger. But same thing from next day, from 1600 it falls down to 1400, 200 point fall in Infosys. So that 200 rupees into 300 shares, that is 60,000 rupees of margin will get deducted from your ledger, and you need to fulfill all this obligation on day-to-day basis. Whatever there will be an obligation in terms of debit, if there will be an obligation in case the stock price goes down, and if you are long on the position, then you need to fulfill on a day-to-day basis. If you don't fulfill this obligation, on the next day the risk team will square off your position. One more advantage of trading in futures and options is you can play on a short direction also, that is on a negative direction also, by shorting your future position. So how does it work? Now suppose you have a short view on Tata Steel, which is currently at 111. You feel that it will come down to 105. So what you can do, you can first short sell Tata Steel at 111, and then once it comes to 105, you can buy it back, and that too you can hold on to this position till expiry. So Now you can not only trade on the upside, but also on the downside you can trade if you have a negative view on a particular stock or index. If you have a negative view on Nifty, suppose at 17,900, you feel that Nifty will go down, you can short sell Nifty future at 17,900, and if it goes down, suppose at 17,700, 800, you can buy it back. There is not restriction that you need to hold this position till expiry. You can hold on to this position till expiry, but in between also, if you want to exit, you can exit any point of time. One more advantage is there is no circuit limit in the futures and options, of whatever stocks which are listed in the futures and options market. So they can go n number of percentage higher or lower. And last and foremost advantage of trading in derivatives, especially in futures and options, is index trading is possible. That is, you can trade on Nifty, Bank Nifty, which is quite economical. Basically, the margin requirement and the risk associated of trading in index is quite less compared to stocks. So here you have an advantage of trading in index, be it Nifty, Bank Nifty, or Fin Nifty. So it's a very good tool if you want to take an exposure in index, because sometimes taking view on a particular stock becomes difficult. But overall, if you have a view on the market, it is quite easy to take a view on a market rather than on a particular stock. So here it is basically recommended that if you've been starting to trade in derivatives market, firstly start your trade with index, and then if you have a good experience into it, and if you're good at it, and now you can go for in stocks, stock futures and options. But always it is recommended to start with index first and then with stocks. So now quickly we'll go to options, a very interesting again an instrument to look upon. So there are two types of options. One is call option and the second one is put option. Now to make you explain your layman language, if you are bullish, you need to buy call option to take advantage of your bullish view. And if you are bearish, that is you have a negative view on a particular stock or index, you need to buy put option, so that if a particular stock or index goes down, the prices of the put option will increase, thereby benefiting you. And same way, you can take a bearish view by selling call option and take a bullish view by selling put option. How? Let us understand with an example. So here I have a view that Nifty will go up. I have a view that the market will go up, that is Nifty. And so I have a positive view on the market, hence I will buy call option. So I bought 18,000 call option at 150 rupees. Now every strike price, now this 18,000 is called as the strike price, and this is known as the premium. So there are different strike prices which are available, and based upon that you can take positions. So if you buy suppose 18,000 call option at 150 rupees, so here you are a buyer of an option, so your risk associated and the capital requirement is very limited. Here your capital requirement to buy this 18,000 call option would be 150 rupees into 50 shares, which is the one lot of Nifty consists of 50 shares, and I have bought one lot. So 50 shares into 150 rupees is just 7,500 is what my capital is, capital requirement to initiate this trade. And here my risk is also limited to the premium I have paid, that is 7,500. And in terms of per share, 150 rupees per share is my maximum risk if in case my view goes wrong. But here, if in case my view goes right, I tend to make unlimited profit. So here we have made you explain in the payoff diagram. This is called as the payoff diagram. So if Nifty expires on or below 18,000 level, I tend to lose 150 rupees per share, not more than that. But if suppose Nifty starts moving up and it moves into my direction, which I had a view that Nifty should go up, then this 18,000 call option, suppose Nifty expires and I hold on this position till the expiry date, and Nifty expires at 18,500. So I tend to make 350 rupees per share as my profit on an investment of 150 rupees per share. So around 2 times of the capital which I have invested, I can make returns from it. So here the risk associated is also less, and my reward is unlimited, how much ever it goes above the strike price which I bought the call option. Now how 350 rupees came? Because the difference between 18,000 and 18,500 is 500 points, and I have already paid 150 rupees. So Nifty expires at 18,500. I will get net 350 rupees as a profit. So now let us understand. So as I told, if I have a bearish view, I can buy a put option to take advantage of the bearish view, and also can sell call option to take advantage of my bearish view. How? Let us understand. Now I have a view that Nifty won't go above 18,200 level. There is a lot of resistance which Nifty is facing at 18,100, 18,200 levels, and I feel that Nifty won't go above 18,200 level. So what I do is I sell 18,200 call option at 100 rupees. That means I'm bearish that Nifty, I'm bearish below above 18,200 levels, because I don't feel that Nifty will go above 18,200 levels, and hence I'm bearish above 18,200 level. So here, if my view is that 18,200 would not go or will not break for this expiry, to take that advantage, I can sell Nifty 18,200 call option 100 rupees. Now here I am a seller of this option, so I will receive premium. So I will receive 100 rupees as a premium by selling 18,200 level, and that is only my maximum profit if in case Nifty doesn't go above 18,200 level. However, if Nifty goes above 18,200 level and against my view which I had, then I tend to make unlimited loss in this strategy, because the selling of options, the risk reward parameters just gets reversed in case of selling of options. And since your risk associated is unlimited and it's very high, the capital requirement to sell this 18,200 call option 100 rupees will also be very high. That is on around 75,000, 80,000 of margin will require to just sell 18,200 call option at 100 rupees, and 100 rupees is only your maximum profit if Nifty expires on or below 18,200 level. So here in the payoff diagram, you will be able to see if Nifty expires anywhere below 18,200 level, I will make 100 rupees per share as a profit and not more than that. But if Nifty starts moving above 18,200 level against my view, I tend to make unlimited loss. Suppose Nifty expires at 18,500 level. Suppose Nifty expires at 18,500 level, then I tend to make a loss of 200 rupees. How 200? Because the difference between 18,200 and 18,500 is 300 points, and 100 rupees is what I have received. So net I will lose 200 rupees. So this is the payoff diagram. Now you will ask then why people will sell options, because the risk associated is very high. Reward is just limited to 100 rupees per share, and capital requirement is also high in approximately 75 to 80,000 rupees of margin would be required. Now selling of options is basically a probability game. If you feel there is 99% probability that Nifty won't go above 18,200 levels, then there is 99% probability to pocket this 100 rupees as a premium, as a profit. So there are many traders who just sell the options rather than they are just interested in selling of options. They are not interested in buying of option because they want a small amount of profit, which is quite achievable in case of selling of options, and they are satisfied with small amount of profit rather than they want to go for a multi-bagger profit. If you want to go for that, based upon your view, you tend to basically earn unlimited profit, but your risk of capital basically, since if your view goes wrong, you tend to lose or whatever capital you have invested. However, the capital requirement in case of buying of option is very limited. But then too, if your view doesn't work, then you tend to lose all of your capital if in case it goes against you. So there are number of players based upon the risk and reward probabilities they take trade into the market. Some of the traders who wants to have a good return on a quick basis, they can go for a buying of option. Some of the traders who wants to basically gradually want to earn money from derivatives market, they can sell options. But yeah, selling of options require a good amount of margin. But we at HDFC Securities can give you margin against your portfolio. If you want to sell options, you can pledge shares on your portfolio, and against that, whatever margin you will be receiving it, you can trade in derivatives market without any interest cost. So you can use your portfolio as a productive means, and also you can use it for selling options, for buying and selling of futures. You can use that margin. So there is no extra margin where you need to bring it in the cash basis for taking any or initiating any kind of in positions. If you have a collateral margin with you, you can set off that margin to trade in derivatives market. Now let us understand about put options. So put option is an interesting way for the traders and for the investors. So first thing I would explain you, if you have a negative view on the market or in a particular stock or index, you can buy put option. So if the particular stock or index falls, the prices of the put option will increase, thereby benefiting you. And same way, you can use put option as an insurance for your big holding in emargin or MTF, or also if you have a big holding in your portfolio, you can use as an insurance against the downward trend. Also, you can insure your portfolio in case there is a negative view on the market by buying put option. So you can use this put option for a various reasons. Put option helps you not only for the traders for the negative view on the market, but also for the investors. So we have given an example. Put option is like an insurance policy to you. Now we have connected this with an insurance policy. So suppose you buy a vehicle insurance and you pay premium to buy that vehicle insurance for your vehicle, and against that vehicle insurance will assure you that if anything happens to your vehicle, either it gets stolen or broken, then we will assure you how much ever damage it happens. Or if it gets stolen, then also we will basically compensate you. Same thing, if you buy put option, you need to pay premium to buy put option, and against that, suppose you buy 17,000 put option, that 17,000 put option is an insurance policy to you that assures you that how much ever Nifty goes below 17,000 levels, I will compensate. But your risk of losing is just a premium which you have paid, not more than that. Same thing on the insurance company. Whatever, if nothing happens to your vehicle, then your maximum loss is the premium which you have paid to insure your vehicle. But if anything happens, then you can that insurance basically company will compensate you. Same thing you can use as a put option also. The premium of losing, if in case your view doesn't match or your particular stock or index for that your put option your bought doesn't comes down, your risk is just the premium which you have paid, that is only your maximum loss. But if it comes down, then it will compensate you how much ever it goes down. So this is an example. Suppose I have a negative view on the market and I feel that the market will go down. So what I will do is I will buy put option. So here in this case, I bought 17,000 put option at 80 rupees. I bought one lot, that means 50 shares. So net I am a buyer of an option. So my capital investment is very less. That is 80 rupees into 50 shares. That is only 4,000 rupees of investment. I can enter this by buying 17,000 put option. Now, if in case Nifty doesn't go below 17,000 level, if it expires above 17,000, the maximum money I will lose is 80 rupees per share and not more than that. But if Nifty starts moving below 17,000 level, I tend to make unlimited profit how much ever it goes below it. So here, suppose if Nifty expires at 16,500 for this expiry, and I hold on to this position till expiry, I can make 420 rupees per share as a profit on an investment of 80 rupees only. That is more than 5 times I can make on my capital investment. So how 420? So difference between 17,000 and 16,500 is 500 points, and I've already paid 80 rupees. So net I will be getting 420 rupees if Nifty expires at 16,500 levels. And now on the selling of option, basically, as I told, if you have a bullish view, either you can buy call option or you can sell put option. So in this case, I have a view that Nifty won't go below 16,800 levels. So what I will do is I will sell 16,800 put option at 50 rupees. Now here I am a seller of an option. So risk reward, whatever the risk reward parameters will get reversed in case of selling of option. Your risk is unlimited if in case your view goes wrong. In this case, if Nifty starts moving below 16,800 levels, I tend to lose unlimited. However, your reward is just limited to the premium you are receiving it. So here, once you sell this 16,800 put option, you will receive this premium of 50 rupees, and that is only your maximum reward if in case Nifty closes on or above 16,800 levels. So here you will see in the payoff diagram, if Nifty closes on or above 16,800 levels, you tend to make only 50 rupees per share as a profit and not more than that. But if Nifty start to move below 16800 level and you hold on to it till the expiry, then you tend to lose unlimited. Suppose it closes at 16,600 levels, you tend to lose 150 rupees per share as a loss. How 150? Because 16,600, 16,800, there is 200 points difference, and you have already received 50 rupees while selling this option. So net 150 rupees that will be losing. So again, selling of options and selling of put option and selling of call option is a probability game. Many of the traders who uses this as a tool to earn gradual income for their portfolio and for their holdings, by pledging some of the securities, they can use that margin to pledge to trade in this selling of put option and selling of call option, so that they don't have to bring any kind of an extra cash margin to do that, because selling of options required a good amount of margin. To sell this one lot of 16,800 put option would require approx 75,000 to 80,000 rupees of margin. So if you don't have that cash margin, you can pledge some of your shares, and against that you can basically sell 16,800 put option at 50 rupees and can earn gradual income from by selling of options and making your portfolio also productive. Now let us understand about different option terminologies. So there are different option terminologies to understand if you're trading in futures and options market. You need to be well versed with this kind of an option terminologies because that will help you to make you understand how the pricing of options, especially in options, takes place. So first, let us understand about spot price and strike price. So basically, this is an pro-terminal snapshot of option chain. In vertical side, which I have highlighted, they are known as the strike price of the Nifty. This is of Nifty. So at every 50 rupees interval, if you be able to see there is strike price available, depending upon view, you can buy the options. How far you have a view, you can buy. But whatever options you want to buy based upon your view, always buy the at the money call and at the money put option. Now, what is at the money call and put? Which is near the current market, the strike price, which is near the current market price. So these are all the strike price. On left hand side, you will see all the call related details, and on right hand side, you will see all the put related details. And on the higher side, which I have highlighted, are the price of the Nifty future and Nifty spot. So on the this 17,945 is the price of Nifty future, and 17,925 is the price of Nifty spot. So this is the spot price and the strike price. And one more thing, the strike price, which is there for 50 rupees interval, every stock has a different interval of the strike price, and that has been decided by the exchanges how much strike price there should be for a particular stock or index, and at what interval the strike price should be. So that is decided by the exchanges, and after that the strike price has been displayed like this. Now three more concepts, that is called as in the money, at the money, and out of the money options. What is it? Let us understand with an example. I'll just give you a theory. I won't go into a theoretical formula or any kind of an basically formula based to make you explain what is in the money, at the money, and out of the money options. On a layman language, if I want to give you an explanation, what is in the money? Because in this options there are three types of options. One is in the money options, at the money options, and out of the money options. So first, let me explain you on the call side. So whatever strike price which comes under shaded part in the call side are called as in the money options. The unshaded part are called as the out of the money options. Same thing is been there for put option. However, if you see the out of the money option strike price gets if you see for the put option and the call option are quite inverse. So here also, if you see whatever unshaded part is there are for the put side are called as out of the money option. The shaded part are called as in the money options, and whatever strike price which is there near to current market price. So if you see Nifty is quoting at 17,925, so 17,900 or 17,950 are called as at the money option. Now, why it is necessary to know at the money option, in the money, or out of the money? Because firstly, you will see the premium differences for in the money option. The premium would be quite high, and the movement would also be quite high. In case the view goes either into your direction or against your direction, you will see quick profit and also quick losses, because the movements of in the money options is very high compared to out of the money options where the premiums are low and the movement of prices is also low. However, at the money options has a dual criteria of in the money and out of the money both. Hence, if you have any kind of view on the market or the index, always if you want to buy the options, always is recommended to buy an at the money option, because they are the one who basically will show highest return if in case your view goes right. So this was all about in the money, at the money, and out of the money option. Now, one more couple of things. In a premium, there are two type of value, which is called as intrinsic value and time value. So let us understand what is intrinsic value and time value in a premium. So here, I'll just make you explain that. Sorry, I'll just make you explain that in this strike price, if you see that particular option is quoting at how much, what is the premium. On the left hand side, you will see all the call related premium, and the right hand side for the strike price, you will see the put related premiums. So if you see that if 17,900 call option is currently quoting at 126 rupees, now you need to know in this in 126 rupees there are two values which are there. One is intrinsic value, and the second one is the time value. So if you want to know how much is intrinsic value, how much is time value, let us understand with a formula. So here, suppose Nifty is at 18,000 level and 17,500 call option is quoting at 550 rupees. So in this, you need to know how much is intrinsic value and how much is time value. Why you need to know that? Because at the time of the expiry, whenever there will be an expiry of a particular options, only intrinsic value will remain, time value will become zero. So that's why if you want to find out the actual value, how much it should be at the expiry day, on the expiry day, it is necessary to understand how you need to find intrinsic value and time value, so that you come to know how much value of the option would be if in case the particular Nifty expires at this point of level. So now suppose Nifty is at 18,000 level and 17,500 call option is quoting at 550 rupees. So 18,000 minus 17,500 is 500 points. So 500 points is an intrinsic value, and over and above whatever the premium is called as the time value. So this time value is like a time bomb. Basically, sooner it comes than expiry, it closes to expiry, the time value will slowly and steadily will try to reach towards zero, and on the expiry day, the time value, or on the at the time of the expiry, this time value will become zero. So same way, 17,800 call option is quoting at 280 rupees. So how much is intrinsic and time? So 18,000 minus 17,800 is 200 points. That 200 points is an intrinsic value, and over and above whatever the premium is, that is 80 rupees, is a time value. So at the expiry, only 200 rupees would be there. If in case Nifty expires at 18,000 only, you will see this option expiring at 200 rupees only, because this 80 rupees of the time value will be zeroed down. So this is how you can basically identify how much is the time value and intrinsic value of the options, so that to understand how much is the value of the option if it expires at this point of level. And last is the maturity and the expiry date. As I made you understand, the expiry date is the last Thursday of every month, and we have a weekly options for Nifty, Bank Nifty, and Fin Nifty, which expires on a weekly basis. Now let us understand of the benefits of options versus equities. Now in equities, what happens? Basically, volatility is quite high, and there is a lot of market swings based upon global news and international news. Sorry, global news and domestic news, and hence sometimes what happens? Exit becomes difficult on your holdings. So suppose if you have bought any kind of an stock at 18,500 index, and last for 3 to 4 months Nifty is hovering around 18,000 level, you might got have stuck in that particular stock, or on the particular stock which you have bought, and there is high probability of getting stopped out if in case there is any kind of sharp movement into the market. Also there would be a massive erosion in the portfolio. But if you are trading in options, first and foremost you can take advantage of the volatility by not only going long, by not only you can earn return from your bullish view, but also on the bearish view. If the market trend is on the negative side, you can buy put option, or you can sell Nifty or any futures, whatever view you have for a particular stock or index. You can short sell it, and you can also earn money on the downward trend of the market by again buying back at the lower price, and also by buying put option. And if market or particular stock or index falls, you can earn return from it. So you can not only earn returns from a bullish side, but also you can earn return on the bearish side. And also there are multiple strategies where you can also earn return from range bound kind of in market scenario. If you have there are various option trading strategies which could be implemented if you have this kind of in view. And also if you have a volatile view on the market, you can trade upon in that view also. So in each and every direction, options can help you to earn return from it, because it's a very dynamic and very vast subject where you can earn return from many directions of the market. This is just a basic part which we have covered, that is of call and put. But apart from it, there are various trading strategies which usually market do follow, and we do come out with this kind of in session on a regular basis. So if you want to understand or for different option trading strategies, so we do come out with this session. We'll also intimate you whenever we have this kind of in session, so you can attend this to understand more in deep how you can trade in different market scenarios with option trading strategies. Also, options as a unique thing that it comes with a predefined loss. If in case it comes with a if you are a buyer of an option, then it comes with a predefined loss, and with a specific time frame and exit, that is the maturity date or the expiry date it comes with. So you know this is the expiry, and till that time only I have to hold on this to this position. And also options are very useful for portfolio protection, or as I told, it can be used as an insurance towards your long positions in cash or MTF, or if you have a big portfolio, you can insure your portfolio against buying put option. And also you can generate income by selling call option on your portfolio. If you have a big holding, you can sell call options and earn return from it. So these are the perspective of volumes which we already discussed in the beginning, that majority of the volumes which is coming on the derivatives market, it's through index options. Apart from, as I told you in beginning, out of the maximum out of the volume which has been happening in NSE, 90 to 95% comes from the derivatives, and from that 90-95%, around 65 to 70% of the volumes comes only from index futures and index options. So and also if you see the volume trend is in last 7 years in derivatives market have increased significantly. It used to happen 2.29 lakh crore per day in 2014-15. Now it is happening 59 lakh crore per day in 2021. So there is a huge spike in the volume which have been happened because more and more participants have been trading into this instrument, because the returns have been made with various strategies and various views. You can trade from with this instrument. So it's a very interesting subject. So I hope after this session we have already gone through what is futures and what is options. You might have got a lot of clarity about how to trade in futures and options. So this will also help you in benefiting you by trading into this segment. So now let us understand about various HDFC security offerings. Since futures and options market required huge, basically you need to have a good amount of low brokerage to trade quickly into the market. If you want to enter quickly or you want to exit quickly into from a particular futures or options, for that you need to have a low brokerage or low cost to basically do that. So we have in 20 rupees per order of brokerage in futures and options, being it futures or in options. How much ever quantity you buy in a particular order, you will be charged a brokerage of rupees 20 per order. For that, it's a flat brokerage. And if you don't have rupees 20 per order brokerage, you can subscribe to our derivative value plan. Post this session, I will just give you the link. It is just worth of 199 plus tax, which is an annual charges. By subscribing to this derivative value plan, which is worth of 199 plus tax, you will not only get rupees 20 per order in F&O, but also will get in free access to the Pro Terminal, which is our advanced trading portal, which is used for various analytical purpose to take trading decisions. So it's a very good tool to trade upon. So by just paying 199, you will get rupees 20 per order in F&O and also a free access to Pro Terminal. And one more feature which I have discussed is basically zero interest on derivative margin. Now, as I made you understand, if you are short of cash, if you want to trade in derivatives market, but you have a portfolio, you can pledge some of your shares of your portfolio or all of your shares of your portfolio. And against that, whatever margin you will receive, you can trade in derivatives market without any interest cost. So this kind of a facility has been given by a competitor. So if you hold on any derivative position for 1 month with our competitor, which charges around 18% interest, you pay 1500 rupees as an interest cost if you hold for 1 month. But here with HDFC Securities, if you opt this facility, which is free for all can use this facility. You don't have to subscribe to anything, or you don't have to accept any kind of rules and regulations. So you can directly pledge your shares, and against that, whatever margin you will be receiving it, you can trade in derivatives market. So without any interest cost, there is no interest cost involved in it, and you can basically use full 100% of that margin to trade in this segment. So that's it from our end. I hope this session was quite useful to all. I will request you to provide us with the feedback. How did you find this session, and what kind of topics you would like to you would like to learn about in derivative per se, for which could be useful for your day-to-day trading in futures and options market. So now we'll conclude this, and we will open this forum for question answer session. So if anyone have any kind of questions, we'll request you to please write it on the question answer section, and we'll reply you back. So Mr. Balla have already asked, so it's a contract, and does the duration of the contract vary? So the contract is fixed. If you are buying monthly contract, then the monthly contract, the expiry is last Thursday of every month. And if you're buying a weekly contract, which is only available in options, that is for Nifty, Bank Nifty, and Fin Nifty. For Nifty and Bank Nifty, the expiry is last Thursday of every week, and for Fin Nifty is every Tuesday. So here, depending upon the contracts which you have bought, you have an expiry date. It comes with an expiry date for that particular contract. So you will be able to know, once you initiate any kind of in positions, you will be able to know what is the expiry date, because in that, once you initiate a position, it is specified that what is the expiry of this contract, and that is the duration of that contract. So Mr. Vinod Sawa have asked us, does it attract interest on the margin or the whole amount? So Mr. Vinod, as I made you understand, we can use this kind of a facility to trade in derivatives market. That is by pledging some of your shares of your portfolio. Against that, whatever margin you receive, you can trade in derivatives market without any interest. So there is no interest which is being charged to you. And that is a very useful tool for an F&O trader, especially the F&O traders who wants to earn a return only by selling of options, because selling of options required huge amount of margin. For that, you can use this facility. You can pledge some of your shares. Against that, whatever margin you will receive, you can use that margin to trade in futures and options market. Yeah, there is no circuit limit, Mr. Balla. So you have also asked me, can you repeat the sum example once more? So can you just specify which example you are talking about? So yeah, Mr. Vinod is asking, what is the charge of pledge of shares or rate of interest for F&O? So as I made you understand, there is no rate of interest. The charges of a pledge would be there, but it is very nominal. If you pledge 2 lakh of rupees of your shares, only 10 rupees or 20 rupees of charges would be there. That too will be charged by your demat account wherever it is with HDFC Bank or HDFC Securities. So that demat account DP, they are the DP charges, which is only 10 rupees on 2 lakh of position if you pledge, so which is very nominal. So Mr. Aditya is asking, where can I get recording for this webinar? So we'll try to upload this webinar into our YouTube channel of HDFC Securities. You can refer that. So Mr. Ketan is asking, on expiry date, call option or put option will be automatically squared off, or should we sell or buy before the expiry? So yeah, you have both these options available. Now it's a very interesting question, Mr. Ketan, you have asked. So for that, many of our participants will also find it useful to clarify all of their doubts. So you have two options available. Either you can square off your position before the expiry, or it will automatically square off. So for index options, you don't need to worry if it automatically gets squared off. It will get cash settled. Whatever profit and loss it will be debited or credited into your account. But for stock options, if the stock options is in the money, as I made you explain that how to identify in the money options, if the stock options is in the money, in that case, if you don't square off your position and if you let it expire, that is, you want it to automatically square off the position at the expiry. If you don't do it manually, then exchange will do it. We also don't do it. Exchange will do it on your behalf, and you need to compulsorily comply for the physical settlement. So how much ever shares you have the positions, you need to compulsorily either take delivery or give delivery of that particular shares. So it is always recommended that if you don't want to go for a physical settlement obligation, they always recommend to square off your options positions before expiry. So Mr. Hemant is asking, applying stop loss. I see it's not user friendly to apply stop loss on option index. Can we have a clear technical scenario to apply stop loss? So yeah, surely we'll just make you understand how to apply stop loss. And are you talking about Pro Terminal or ITS of or N-Trade or Empowered? So we'll give you an explanation of both our trading platform. So first we'll take the normal ITS platform, and then we'll go to Pro Terminal, how to apply stop loss. So this is the Empowered segment. Now suppose you have a position of 17,900 put option at suppose at 98 rupees, and you want to apply a stop loss at 65. So what you can do is you can press on sell. You want to apply for a selling stop loss. Click on additional details. Under additional details, you can keep a stop loss 65 as a trigger price, and limit price here should be lower than your trigger price. Suppose you place at 64 and you place the order and you confirm. So this stop loss order will go into the exchange. Whenever it will come 65, it will automatically get squared off. Now same thing if you want to apply stop loss order in Pro Terminal. So let us understand with the same strike price of 17,900 level, which is at 96. Now, if you want to place a stop loss, click on sell. Under order type, click on stop loss SL order. Here, trigger price 65 and limit price 64. So you need to select SL in the order type, and then you need to place this order and confirm. So this order will go into the system with this stop loss price. I hope it is now easy to you. So Mr. Sashi is asking how to trade in options in range bound market. So in range bound market, there are different strategies like short, straddle, or strangle. What you have to do is you need to suppose you have a view that Nifty will expire at 17,900 levels. So you can sell 17,900 call and simultaneously sell 17,900 put. Suppose you receive a premium of 200 rupees by selling this call and put, and if you want, if the Nifty expires at 17,900 itself, you pocket all 200 rupees as a profit. So there are various strategies. I won't go deep into it. I've just given you a brief. You can Google it around in the website how to what are the strategies to play upon in the range bound kind of a market. They will be able to give you lot many of study material for that. You can also refer to our HDFC Securities channel in YouTube to understand about different market concepts. So Mr. Vijay Kumar is asking, is the Pro Terminal supports API interface for Python? No, Vijay, we don't have as this kind of a facility as of now. Yeah, Mr. Vinod is asking, please share link of rupees 199. Surely, you can just Google it, derivative value plan of HDFC Securities. But make sure before having derivative value plan, you have derivative privilege. That is, that your trading for derivatives has been registered, because to trade in derivative F&O, you need to have a derivative privilege. So I will give you both this link. I will share with everyone. So first link which I have given is the derivative value plan. If you have a derivative privilege already, you can subscribe to this plan. And if you don't have, first subscribe to derivative privilege, which will get activated in T+3 days, and then you can subscribe to derivative value plan. So this is the derivative privilege. So I've given to all. You can use this as a tool to get rupees 20 per order by subscribing derivative value plan. Mr. Hemant is asking, how do you pledge shares of F&O options? Is it applicable for NRI? No, this pledging of shares is not applicable for NRI account. Mr. Sashi is again asking how to trade in options in range bound market, as I made you understand. Will you be sharing the link of the recording of this session? I was a bit delayed, so I missed start. So what I will do is I will ask my team to upload this into our YouTube channel, and you can refer into our YouTube channel. You can refer this link and can see the recordings of this session. Very informative. Thank you. You talked about index options. Okay. What about options in individual shares? So it is the same criteria to give you, and see, as I made you understand that 60 to 65% of the volume happens in index options and index futures. Majority of the clients and majority of the traders prefer trading in index. Hence I made you, hence I gave you that example of index and made you understand. But it's a similar concept. If you want to trade in stock options, it's only a similar concept. Apart from physical settlement, only there is one differentiation of stock options, that at the time of the expiry, if you don't square off your positions for in the money stock options, then you need to settle it for a physical settlement. So that's only one differentiation. Rest all things are similar, which is there for index options, that is there for stock options also. One more interesting question by Mr. Tarak is how to roll over if you do have a place spread order in Empowered platform. So we do have a spread rollover position. So in the Empowered, if you go to, there is a feature called as rollover spread order. So here in Empowered, now this is the Empowered. Under derivatives, you will see the last option, which is their spread order. Once you click on spread order, suppose you want to roll over, suppose you want to roll over Nifty future, just type Nifty as in the symbol and select the date you want to roll over from February to March, from February to April, March to April. Suppose I want to roll over from February to March, I will select February to March, and I will get that ready-made difference, how much ever it is quoting between February and March. And once I enter the rate, suppose I want to roll over at 103 rupees difference, I place the order. And once I confirm, this order will go into the system, and once this order matches 103 rupees difference between February and March, automatically February month contract will get squared off, and your March month contract would get buyed. So this is how you need to roll over your positions of futures, and rollover only happens in futures. So there is one more question by Nityanand Nayak. When will you conduct sessions regarding how to use Pro Terminal? So we do conduct this session on every week for different Pro Terminal features. We have our product manager Krishan Bera who basically conducts this session. You can also ask your relationship manager that whenever there is session, please inform me and give me the registration link, or you can refer to your email ID whenever there is any kind of an webinars. We do give you an email notification for that on your registered email ID, so that you are informed about all those webinars which are happening, and you can be registered for it and attend that. So on a daily, every week we have a session on the Pro Terminal. You can attend that. So Mr. Vinod Aswa is asking session on various strategy explaining hedging strategy. Yes, we will come out with this session. So next week also will come out with this session. So you can basically stay in touch with your RM or refer to your mails. And also if there are any kind of a webinar, you can find it into our HDFC Securities portal. If you go to HDFC Securities platform, you will be able to see what our webinars are there. And you can check that webinar, and based upon your interest you can attend. So Sandhya Maheshwari is asking, the price prevailing on date of expiry will be compared against strike price irrespective of movement in price before expiry of contracts. So it is price prevailing on a date of expiry of this cash market price. So whatever there and the cash market price, based upon that the settlement happens in the options. So Mr. Balla is asking to have a sell call example. So sell call, we have given you an example of the sell call in our website. Sorry, in a presentation. So this was all about sell call option. Now I'll just give you a brief of how to basically you can. So here you have a view that Nifty won't go above 18,200 levels. So what I do is you can sell 18,200 call option at 100 rupees. So here, if you're a seller of a option, your risk reward parameters just gets reversed. Your risk is unlimited if in case your view goes wrong. In this case, if it goes above 18,200 level, your risk is unlimited, but your reward is just the premium which you have been receiving it. So in this case, only 100 rupees is the premium you will be receiving it by selling 18,200 call option. That is only your maximum profit. So if Nifty expires on or below 18,200 level, you will make 100 rupees per share and not more than that. But if Nifty expires above 18,200 level and you hold on to your positions, your risk is unlimited. So this was the example of selling options. So one more question by Mr. Ravi is how to activate F&O in our terminal. So I have already given the link of derivative privilege. I will again share the link with you how to opt for derivative privilege. So you can subscribe to this. You have to register, upload the documents which is required, and you can opt for derivative privilege. So Mr. Harshit is asking, I'm not able to upload statement for activation for derivative section. So whatever error you are receiving it, Mr. Harshit, please take a screenshot of that error and pass it on to your RM, or you can also pass it on to our customer service team. That is, you can email them to service@hdfcsec.com, and they will reply you back for that. How many days before expiry date we need to square off the quantity if do not want to give or take physical delivery? So Sandhya, there is nothing as such how many days before the expiry you need to square off the quantity. So you can just expire, you can also square off your positions before the expiry of the contract, before the end of the trading session of the expiry date. So before 3:30, whatever time you want, you can square off your position. So there is nothing as such that you need to square off a particular days you need to square off your position. you can just square off before the close of the market hours of the expiry day. So there is one question by Mr. Sashi Narula, how to use open interest data in options. So it's altogether it's a different concept to make you understand. But yeah, we on every Wednesday at 4 o'clock we come out with weekly F&O outlook, which our research team provides us with their outlook on the market and also explains you how you can read the open interest data. So every Wednesday at 4 o'clock we do come out with this session. So we request you to attend this session to understand about open interest. So I think I have answered most of the questions. The rest all are Mr. Biju have asked one question. How do I know who is my RM? So you can coordinate with your customer service team by providing them with your trading ID, and you can ask them to provide me the RM details. The customer service team will provide you the RM details. If you don't have RM, then customer service will provide you an RM for that, and you can get in touch with them. So I thought, so I think we have answered most of the questions. Thank you all again for attending this session. I hope it is quite useful for your trading in futures and options market. So I thank you all for attending this and have a nice and a very good weekend. Thank you.